Got a big finance test breathing down your neck, feeling kind of varied under all those different ratios? Don't even worry about it. This is your ultimate crash course. We're going to get you ready to absolutely ace that exam.
I absolutely love thinking about it this way. Financial ratios aren't just boring numbers on a spreadsheet. No, they're like a company's vital signs. They're the symptoms you look for to figure out if a business is actually healthy or if it's sick. It's like we're doctors, and we're about to make a diagnosis.
So let's be super clear about our goal here. We are not going to be doing a bunch of complicated math. The whole point is to get you ready for your test. And that means you need to be able to recognize these formulas instantly and know what they're telling you. We're all about the what and the why, not the number crunching.
Okay, so before any doctor can diagnose a patient, they have to know how to read the chart, right? Well, in finance, our chart is a company's financial statements. This is where all the data, all the clues for our ratios are hiding.
And here they are, the two big ones, the balance sheet and the income statement. The absolute easiest way to remember the difference is this. A balance sheet is like a snapshot, a picture. It tells you what a company owns and what it owes on one specific day. The income statement, that's more like a video. It shows you the company's performance over a whole period of time, like a quarter or a full year. You really need both to see what's going on.
All right, first up, liquidity ratios. This gets to the most basic, most fundamental question you can ask about any business. I mean, forget about growth, forget about profit for just 1 second. Can this company even survive? Can it pay its bills next week?
So yeah, that's the textbook definition. But just think about it like this. If a company's sales suddenly drop to 0 today, could they still make payroll next month? Could they keep the lights on? It's all about having stuff you can turn into cold, hard cash fast.
Now, here's what's so cool about these. See the pattern? They get stricter and stricter. The current ratio is kind of the easy, broad look. Then the quick ratio jumps in and says, whoa, hold on, inventory can be tough to sell quickly, so it takes it out. And finally, the cash ratio is the ultimate stress test. Just pure cash and nothing else. It's like a series of tests, from easy to really, really hard.
Let's move on to our next set of diagnostic tools. Now we're asking two totally new questions. First, how good is the company at using its stuff, its assets, to make money? And second, how much is it relying on borrowed money, which, always adds risk?
These are called activity ratios, or sometimes efficiency ratios. And honestly, you should think of these as a report card for the company's management. Because it's one thing to have a bunch of buildings and machines, it's a whole other thing to use them well to actually ring up sales.
Okay, here's a huge test-taking tip for you. If you see a formula on your exam that has revenue or sales on top and some kind of assets on the bottom, chances are extremely high that you're looking at an activity ratio. Total asset turnover looks at everything, while fixed asset turnover just zooms in on the big-ticket items like property and equipment.
Next up is leverage, and this is all about debt. Now, using debt can be like strapping rocket fuel to your company. It can make you grow way, way faster. But as we all know, rocket fuel is also super dangerous. These ratios tell us just how much of that risky fuel a company is playing with.
So for your test, look for the word debt or liabilities in the formula, usually on top. Debt to assets and debt to equity are basically telling us how much of this company is paid for by bankers versus the actual owners. Then there's times interest earned. Think of this one as a safety check. It asks, hey, are your profits big enough to easily cover your interest payments? If that number is low, that is a huge red flag.
And this right here is the whole game when it comes to leverage. It is a constant, stressful balancing act. You want to use just enough debt to outgrow your competition, but not so much that one bad year could put the entire company at risk of going under.
Okay, we've checked for survival, we've measured efficiency, and we've sized up the risk. Now we get to the part everybody really cares about, making money. Is the company actually profitable? And, just as important, what does the rest of the world, the stock market, think about this company?
Profitability ratios. These are the bottom line. At the end of the day, after you pay all the bills and sell all your products, how much money is actually left in the pot? That's what these ratios measure. They show how good a company is at turning its sales or its assets into actual, real profit.
For your test, the big clue here is net income or profit. You're going to see that on top of the formula almost every single time. Return on assets tells you how much bang for your buck you get from your assets. Return on equity is the one the owners really care about. And profit margin is simple. For every dollar of sales, how many cents do you get to keep?
Now for our last category, let's try a little analogy.
Picture this. You buy a pack of baseball cards. The physical cost of the cardboard and ink for one card, what we'd call its book value, is maybe, 5 cents? But if you pull a super rare rookie card, someone out there might be willing to pay $91 for it. That's its market value.
And believe it or not, it's the exact same idea with giant corporations. The book value comes from the accounting numbers, from those financial statements we talked about. But the market value? That's decided by millions of investors in the stock market. It's what people are willing to pay for a piece of that company, right now, today. So market ratios are what connect the dots between the tidy world of accounting and the often messy, emotional world of the stock market. The most famous one, by far, is the price-to-earnings ratio, or PE. It compares the stock price to the company's profits. A really high PE ratio usually means investors are super optimistic and expect big things in the future. Okay, wow. We have covered a ton of ground. So let's put it all together on one final slide. Think of this as your ultimate cheat sheet, the one thing you glance at right before you walk into that exam room. Okay, let's do a rapid-fire review. Liquidity? The question is, can we pay our bills? Activity? Are we efficient? Leverage? How much risk are we taking on? Profitability? Are we actually making money? And finally, market ratios. What do investors think we're worth? If you can just remember those 5 core questions, you are going to be in fantastic shape.
So as you get ready for your test, just remember this. Ratios are not the final answer. They never are. Their job is to help you ask smarter, better questions. Which kind of leads me to a final thought for you. Do you think financial analysis is more of a precise science? Or is it more of a creative art? Something to chew on. Good luck on your exam.